Okay, good morning, everyone. And thanks for registering for and joining our webinar this morning. I hope you're keeping well, despite the challenges of lockdown and keeping your business organization functioning as best you can. My name is Patrick Gallant, and I lead our People and Change consulting practice in Grant Thornton. Change is certainly something that all of us have to contend with, and even more importantly, as we try and look beyond COVID-19 and understand what the new normal is going to be and how we prepare for that. I'm delighted to be introducing 4 of our experts this morning in different areas, covering everything from economic impact, tax reliefs, funding, and people challenges to provide you with some practical tips on how your business can plan for a post-COVID-19 environment. There will be an opportunity to send in questions throughout the webinar, and we have some time set aside at the end to cover as many as we can, and indeed we might answer some as we go along. We will shortly start with Andrew Webb, our Chief Economist on the economy, followed by Eugene O'Neill, a Director in Tax on utilising R&D tax reliefs and how that might help cash flow, followed by Neil Shanks on getting your business ready to invest for the future. And finally, Anne Phillipson on leadership and some of the new ways of working. So we have a fairly tight agenda in terms of timing and what we want to cover. So probably it's best maybe to kick off. So if I could maybe throw a question at Andrew before we hear from him. Andrew, you spoke recently about the immediate impact indeed impacts on the economy in terms of sharp declines in the labour market and business confidence. Is clarity emerging on where the economy is heading, and what are some of the key trends that might maybe shape our economic future?
Thank you, Patrick, and good morning, everyone. Well, you asked there if clarity is starting to emerge, and I suppose the answer is, like all true economists, on the one hand and on the other hand. On the one hand, we are seeing some immediate signs of a deep and damaging decline. We saw yesterday the claimant count numbers that came out showing a really shocking increase and an immediate increase in the number of claimants in the economy. And that's really starting to provide some official statistics behind what we've been fearing and what we've been thinking is going to happen in the economy over the next quarter, several quarters, and then indeed into the full year and beyond. And as we try to think through what's going to happen, we have a plethora of opinions on that. But I think what the consensus seems to be forming around, and if we look at these 14 different forecasters and their views on it, there is a consensus that it is a very deep and immediate decline in economic output. We don't probably need models to tell us that. We're all living it day and daily. We know we can't go to the shops. We know we can't go about our normal business. So we expected this sort of decline. I think the scale of decline is probably for the first time in a while we can use unprecedented without clichéing it. It is an unprecedented potential decline in economic performance, and one which stretches into the full year. So just in terms of where we are currently and where thinking is, there's a real sense that the decline could range from -7% to -20%. So it gives you a sense of just that level of uncertainty. But as I say, we are starting to see some of the official statistics coming through to bear this out. As I said, claimant count statistics yesterday particularly worrisome. And those that have ventured into checking and looking at how this will impact sectorally are showing that there isn't really a sector that escapes this, other than, I suppose, the obvious one of health activities, given the pressures that are being applied to the health sector. So in terms of projected declines in output over quarter 2, education, accommodation, food services and construction, all projected to really take a significant hit. But as I say, not many sectors there escaping that. That starts to really hone our thinking as to the potential impact both around economic output and labour market output. But when we're considering where we go next as an economy, we have to think about the various far-reaching consequences of this pandemic, and those really do touch on so many parts of the economy. We have indicators there of areas of potential impact right across the whole gamut of economic performance. So if we think about households, we think about people who have been furloughed, who maybe don't feel as confident as they were, who aren't doing as much on the retail side and the leisure side, obviously, but a confidence that starts to ebb away. And as people lose their jobs, that in terms of those additional claimants on the unemployment register, that really starts to suck demand out of the economy, and that's something that can start to gather a downward negative momentum. That feeds through into the financial sector. If people are less confident, they save more. If they've lost their job, they start to maybe, the number of defaults on debt starts to increases, and then that starts to spread into the financial sector, which that starts to damage their appetite then for how prepared they are to lend into the wider economy, how they're prepared to lend to businesses. And then we have the business confidence and the change in how businesses have had to perform. So we've had supply chain disruptions, and what that means for businesses here being able to service the customers that they do have. But then we can start to think about how there might be some opportunities within all this as well. So it's a very downbeat picture. I think what this picture starts to show is that there are significant unknowns that are very hard to plot. And, you know, those of us that follow the media, which I'm sure we all do religiously at the moment, just to see where, you know, we are with both the pandemic and business performance. You probably heard about the various alphabet letters that are being applied to our future path of the economy. The one, I suppose, that was most hoped for in this is that the economy would act in a V shape. So we go an immediate decline into deep freeze, but then an immediate bounce back. It's increasingly likely, in fact, it's almost certain that it won't be a V-shaped recovery. And so I suppose the hope then is that it becomes I think a U-shape or a swoosh shape. The Nike swoosh seems to be gaining a lot more momentum in where people's thinking is at the minute. And really those are downturns that are sharp and immediate, and then there's some protracted damage to economic performance, but the recovery kicks in and is a bit more gradual. And, you know, the difference between U-shape and swoosh is really just a matter of pace. I think there's a potential, not entirely likely, and it will be determined a lot by how we as consumers feel. Behavioral economics will probably come to the fore a lot here in terms of where we go next. And that's really the potential upside for what we call revenge spend. So we've been in lockdown for a considerable period of time. When we get back out to some level of normality, does that fuel a splurge in spending, which we then, you know, increased leisure activities, increased social activities, which bumps the economy up dramatically. So that would be a really positive outcome. The two that we really don't want to see, but our potential and our risks are a W shape, where we come out of lockdown too soon and then have to go back into it. The economic and the psychological scarring of that would be significant and would lead to a much more protracted and bumpier journey back to economic performance. And then worst of all outcomes potentially would be an L shape, where we see significant scarring in the economy and lots of business and lots of activity doesn't come back for a significant period, if not permanent amount of time. So those are potential scenarios where the economy is heading. And, you know, I think as we saw at the start with 14 different forecasters, there's not a lot of certainty about where the economy is heading. So it's only a case of where we can hope it heads. And I think the aim there would be for a U-shape or swoosh-shape recovery. And I suppose this gives us a sense of where the economy might go, which is very uncertain. But there are a number of emerging considerations and some longer term trends that do start to point towards where we might be heading and, you know, opportunity for business. I think what we've learned throughout this last 8 or 9 weeks or so is really where the fault lines in our businesses are, and that will lead to lots of thinking around what we do next. So we've really had to rely on technology, and in the main it has held up, and that gives us a sense as a business community of what can we do in future that we were maybe suffering from in the past with the dreaded phrase, "we've always done it this way." That no longer holds any water, and we've had to move rapidly as a business community to do things differently. And that can lead to innovation, and that can lead to better process. So there's a glimmer of light within that in terms of how we operate as an economy in future. And then there's lots of questions starting to emerge around whether or not we need smaller commercial footprints, as the home working has really embedded over the last while. There's several views on that as well. Do we need bigger commercial footprints so that we can socially distance within the workplace, is one potential option. For us, many of us, it's been relatively straightforward to work from home, but I've been on many calls with colleagues across our network, and you see a lot of people sitting on the sofa with their laptop because they've nowhere else to work, or the kitchen table. That's not a long-term solution to reducing commercial footprint. So there's lots to think through there, and it's not just as simple as saying, "Oh, we can all work from home now," so the commercial sector can rethink commercial properties. And then we need to think about some longer term trends around how the sharing economy has really boomed in the last 5-10 years or so, but we've been forced towards an isolation economy, and that's really seen a rapid increase in the digital revolution in retail, for example. It's also seen a lot of adaptations in how restaurants, for example, are now offering click and collect, bring it home and follow the instructions to cook it yourself. So there's lots of quite innovative things emerging in the wider economy. I think also in terms of opportunity, and I'll take these last 2 points together, we've got localism potentially replacing globalism and rise of the robots. I think the disruption to global supply chains is making us think about how we become more resilient as an economy. So do we need to diversify supply chains or localize supply chains? And does that provide opportunity for other businesses to emerge into the local economy to help supply that and help solve that issue? But also just how unprepared many of us were across the economy for most of our staff having to go into home working, and where we could, has given more thought to automation and AI, which had been an emerging trend, but may well see firms push on with automating processes and being really innovative in that space. So I suppose to answer the question, Patrick, I've spent several minutes there maybe telling you that we don't know where we're going and there's some certainty, but on the other hand, there's no certainty.
Okay, Andrew, thank you. Well, certainly, and some various points coming out of that in terms of some of the things that could turn out to be the case. I suppose those are stark words on a deep and damaging decline, particularly in the first slide. And then interesting to note the impact of localism replacing globalism. So lots of food for thought. Thank you for that. And we'll come back to you maybe later in terms of questions. Okay, if we move next to Eugene O'Neill. Eugene, we've heard Andrew talk about how businesses are likely to look inwardly and how they could adapt their products and processes. Are there any tax reliefs available for these companies to utilize to help with that cash flow?
Yeah, thanks, Patrick. In this time of uncertainty, R&D tax credits and other tax reliefs could be an invaluable source of funding for many clients, and we have seen an increase in demand for these services as clients aim to reduce their tax liabilities and generate refunds. R&D tax relief in particular is a wide range of relief and applies to businesses of many sizes and many sectors. We have seen claims in businesses from manufacturing to construction. An SME can get up to 33% of their qualifying expenditure back as a refund, and a large company can get up to 10.53% back, the headline rate being 13%, but this is taxed. R&D is becoming more widely known. We've seen many new claims, but we have seen those vary in terms of quality. We have seen a lot of claimants making claims without having specialist advice, and therefore the documentation, the support and evidence hasn't always been strong. This can lead to HMRC inquiries, which can be hard to defend the full value of the claim, and sometimes can lead to penalties and HMRC looking to go back previous years. And therefore it's important not just to have your first R&D claim documentation right, but also to have every R&D claim documentation right. Another error we would often see is the people do not take into consideration research and development allowances when considering R&D tax claims. R&D allowances should be considered alongside R&D tax relief every time. R&D allowances are available for capital expenditure incurred by a business. It's the most generous capital allowances as it allows up to 100% of your expenditure incurred in a capital project. This allows, for example, if a company was to spend money on new property, the walls and the roof and the foundations used to house that R&D activity could get 100% tax relief in the first year. We also see costs not quantified correctly, such as test and production labour. This is quite often overlooked, despite the fact that the production team, which is a large cost for many businesses, do test the R&D activities. However, clients tend to focus on the design team as it is the most obvious R&D cost. Qualifying indirect labour is also often missed. Qualifying indirect labour can be for admin staff, finance staff, HR staff, but these staff support R&D staff as well as non-R&D staff. So if 50% of your team was doing R&D activities, and 50% of your admin staff should also qualify for R&D. We also see labour costs miscalculated a lot. I have seen claims where companies have submitted 100% of an individual's costs for R&D tax relief. That can be hard to defend, and it's rare that someone would spend 100% of their time on R&D activities. Many clients may also use a timesheet approach, but this doesn't take into consideration the cost of absence for staff. So if they've got holiday pay or maybe off on maternity, if they're an R&D staff member, some of those costs could qualify. Also, a lot of admin time can be spent during core working hours. Therefore, activities done by certain staff members and overtime can often be overlooked because it's not recorded in timesheets, and therefore claims can be lower than they should be. Material costs aren't always identified correctly, as you cannot claim material costs for a product which has been sold for market value. These rules changed in 2015, but some companies continue to claim material costs for products which are being sold at market value. You can, however, claim material costs for prototypes which are being scrapped as a result of R&D activity, or if they're being sold at a discount to clients to prove the R&D activities. Cash extraction is also something that's not taken into consideration very often when for businesses which have R&D claims. So the default position seems to be for many companies to just take dividends as a cash extraction method. However, what if that company does R&D, and what if the individuals, the shareholders, are heavily involved in those R&D activities? We had a recent example where two shareholders were taking a basic salary, but they wanted to take out one-off 150 grand each, and they were asking, should we take salary or dividend? We put this through our model, which take into account national insurance, personal tax, employment, national insurance, and corporation tax. By taking the full thing as salary, the total tax to both individuals was a combined 62k, where if they'd taken the full thing as dividend, it was 103k. These guys were heavily involved in R&D, but not many companies take into account R&D when they're considering their cash extraction. Something else I would like to touch on is capital allowances briefly. Most of you will know that capital allowances are available to companies for their capital expenditure instead of depreciation. It's HMRC's way of giving you tax relief for your R&D projects. In 2018, structural buildings allowances were introduced, which allow 3% from the Finance Bill 2020 per year. However, not many realise that items which qualify for plant and machinery allowances and integral features special rate pool do not qualify for special rate pool. Therefore, you must undertake a cost segregation exercise to identify these costs. This slide is quite useful for companies to benchmark their capital expenditure to ensure that they've identified the appropriate capital allowances. So it's worth noting, if you have, for example, a nursing home, are you in the range of 30 to 50% qualifying? Have you claimed that amount? However, if you've underclaimed or you've missed a claim, provided you still own the property, there is a way to review those historically. And I have an example of an historic capital allowances claim. We had a client who purchased 3 properties between 2005 and 2007. They hadn't previously identified capital allowances, and in the year 2017, we identified this opportunity, and the clients were selling these properties. They had about 7.6 million of cost. We identified 2.6 million of qualifying capital allowances. This equated to 509,000 reduction in their tax liability. However, if you don't have a tax liability equal to that amount, you can transfer that to the future owner of that property, and just kind of increase the sales price of those properties. So, Patrick, yes, we do see many people focusing on R&D capital allowances, patent box, and these ways of boosting their cash flow at these times. I think you're on mute there, Patrick.
Yes, better. Thank you, Eugene. Just one quick question before we move to Neil. There was some talk about HMRC processing these claims more quickly given the current environment. Is that the case? Are you seeing that in practice?
We are seeing clients' claims being processed quicker. HMRC have allocated more resource as they understand the importance of getting this cash out into the economy. There was previously a delay in these claims, but I have seen them and our clients' claims being processed much quicker. Okay. You could get a refund within 4 weeks of a claim being submitted, and that's a target for HMRC.
Yeah, well that's a bit of good news. Okay, thanks, Eugene. A complex area, but obviously tax reliefs, if you can utilize them, could have an important impact on cash flow. Just one quick reminder, at the bottom of your screens, there is the Q&A box. So, and if you have any questions, they come direct to me and the panelists, so we can pick them up and pick them up either during the session or at the end, depending on timing. So please feel free to type in. And no one sees your question in terms of the other participants. So there's such a thing as a stupid question. So if you have questions sort of prompted by some of the content you're hearing, just type them in, and the panelists can sort of pick them up at the end in relation to what we're covering. Okay. Neil, moving on to you next, and the whole sort of important area of funding and investing. So how can businesses use loan schemes over the coming months to soften the impact as other schemes such as furloughing, job retention scheme are withdrawn over the medium term? And I suppose longer term, will businesses and banks need to restructure debt to ensure longer term financial stability?
Yeah, thanks, Patrick. Yeah, I mean, it's fair to say there has been a mixed response to the loan schemes so far, both in the sense of how banks are approaching the loan schemes and in terms of businesses' willingness to take on additional debt at what are difficult times. But it's certainly they are going to become increasingly important over the next 6 to 9 months as other schemes are withdrawn and to replace that source of funding. And some businesses will find it quite easy to access those loans, some will not. And for others, it'll depend on the strength of your application to the bank. And having been both sides of this, working in banking and corporate finance, there's just a couple of key points that I want to cover off today in terms of that application. One is understanding both perspectives. So understanding the bank's perspective is important. You need to understand where the bank will see the issues, and you need to address those risks. And secondly, is having a well-structured application. That proposal is your opportunity to put forward your case, show that you've identified the risks, show that you've mitigated the risks, and give you the best chance of success when you apply to the bank. So firstly, looking at the borrower's perspective, I mean, there's a couple of main loan schemes. The bounce back loan scheme, I don't really intend to talk about too much. It's pretty much automatic money up to 50,000. So I'm really sort of referring to the 2 CBILS schemes. And what businesses are doing at the minute is really a continual process. It's a process of, taking more actions for your business, taking more actions as directors, utilising the different government supports that are coming out, dealing with your existing funders on forbearance that's available to you, and constantly reforecasting your cash flow to see what your borrowing requirement might look like into the future. And that's something that businesses are doing continually, and talking to the banks continually, and getting a better picture of where they stand and what their borrowing requirement might be. Looking at the bank's perspective, I mean, the banks have certain challenges in their own businesses. I mean, operationally, they're challenged like all businesses at the minute. Sorry, just go back to the last slide. Yes, so they're challenged in terms of their operations. They're going to be challenged in terms of profitability. They're going to be challenged in terms of future impairment to their loans. But the flip side of it for the banks is that they have been given these tools and given the opportunity to be part of the solution. There's mutual benefit in using these tools for their borrowers. And also, it's not lost on the banks. This is an opportunity to maybe repair some of the reputational damage that was done during the financial crisis. So a couple of key considerations on the bank side of things. One, I mean, Andrew had a slide earlier around the impact on different sectors. You know, in good times and in bad, there are different sector appetites within banking. That's going to be much more acute at the minute, given the different impacts on different sectors. And I think the second thing that you need to be aware of is there will be a big difference between being a borrower of the bank and a customer of the bank. So to take an example, I mean, if a bar or restaurant business had £1 million of debt to the bank and was in difficulty and needed £100,000 to shore up the business, it's a no-brainer for the bank to use this loan scheme to advance that money, shore up the position of that borrower, and shore up their own position by advancing 100 grand, but only taking really 20 grand of additional exposure, given the guarantee in place. However, if you take an identical business that doesn't have exposure to the bank, you're asking the bank a very different question. You're asking the bank to take a 20% exposure on that additional money in your business when they currently have no exposure. So that's something to think about. So I think understanding both sides of any sort of application to the bank is important, and understanding that in the context of your business. In terms of application structure, I mean, something that's broadly applicable, I think, here for any business if they're looking to structure an application for a CBILS loan would be to simply put it into 3 sections. So before COVID-19, during and after COVID-19, and at each stage to explain the position, confirm the key points or address the key risks, and then provide whatever information is going to be needed at that stage. So if you take before, you know, you're going to be explaining an overview of your business. You're going to be confirming that it was a profitable, stable business, track record of repayment with the bank, and you're going to provide the latest set of financials that you have pre-COVID-19. During, you're going to explain what the impact is on your business. You're going to confirm that you've taken all the necessary actions to protect your business. And you're going to provide a cash flow showing what your funding requirement is. And then after, again, you're going to explain that you've done a risk analysis. You see where your business is. You have a business plan going forward, and you're going to confirm that you have the ability to repay whatever your total debt picture will be after COVID-19, and provide information, you know, on financials. Normally, that's going to be some sort of high-level set of projections over, say, 3 to 5 years, based on your normal trading pre-COVID-19, to show that you can repay that debt. So that's a structure that could be broadly applied. The level of content will just depend on your business and your relationship with the bank. So looking forward, you know, and I'm really looking into next year on this slide. I mean, some businesses will be unsustainable and will enter an insolvency process. I think that's taken as read. You know, other businesses will come out of this and be able to manage their debt quite comfortably on their existing terms. But for a lot of businesses, they will be sustainable, but they'll have been knocked out of their working capital cycle. They'll have been knocked off their repayment path, and they're going to need support from the bank to get back on track, you know, with both working capital and with repayment. So I think restructuring of debt is going to become an important point. And I mean, it's worth probably pointing out here some differences from the financial crisis. If you think back to the financial crisis, banks had lent fairly aggressively. Businesses were lot of them were over leveraged. It was a credit crisis, so you had an absence of liquidity. You know, the banks had a big cost base. The documentation was messy. You know, there were a lot of issues there. You had the property bubble within that. And so what you had the last time was really an approach that was dominated by exit and recovery, because you had very little options available in terms of restructuring the debt. There simply wasn't the ability to service and repay that debt in most cases. If you look at it this time round, the banks have been much more cautious in their lending over recent years. They are much more stable. Businesses have been much more prudent in their borrowing. They are much more stable. Liquidity will return as trade returns. So you have something to play with here. There are options, and I guess you know, we're all hoping that the dominant approach in banking looking forward is going to be one of renewal and debt restructuring. And in terms of what debt restructuring is, it's quite difficult to define, and in practice, you know, it's a lot of meetings, it's a lot of discussion, it's trial and error, it's negotiation, it's seeing what works, and it's trying to find some sort of agreement that both sides can pick up on, agree to, and it improves the structure. But if businesses wanted to put a bit of structure around their thought process in terms of debt restructuring and what options might be available, I think it's sometimes useful to look at what the weaknesses and the threats are in that structure for both sides, and to look then at what strengths and opportunities you have to deal with those weaknesses and to deal with those threats, to mitigate the risk, and to simply have a structure that is easier to service and repay. So some examples are around that, things you can be thinking about. You know, if your weakness or your threat to your business is that you come out of this and you have a working capital deficit, you have threat of creditor actions, you know, what can you do there? You know, can you get a cash injection? Have you a property that you can ring fence and re-gear to bring money in? Have you a property you could do a sale and lease back? Could you use your pension fund for that? Is there some shareholder money could come in, and could the bank match that? You know, are there tax efficiencies? Eugene mentioned some, others, like can you regroup your businesses and use tax losses to improve your cash flow? Have you a hardcore debt within your overdraft? Will the bank carve that out, allowing you to use all of your overdraft available? You know, is there invoice finance available? The stock facilities available? So they're all the type of things you want to think about there. If your weakness happen to be that you think you're going to struggle making your repayments, obviously you can look at the term of the debt. Is there seasonality you can build in? Is there a reallocation of the debt that works better? Can you look at your pricing? So can you ratchet your pricing? Can you back end your pricing? Could you take some margin off your interest and replace that with a back-ended fee? So you know, they're the type of things you want to look at when it comes to repayment. You know, if your issue was security, so if the weakness for the bank was security, can you look at bringing improved security or additional security to the table? If the threat to the borrower, as you see it, is that there are guarantees in play, you know, would the bank agree as part of an overall deal to ratchet down those guarantees, maybe as certain targets and milestones are met? So there's just some of the things that I think businesses can be thinking about. What does your debt look like when you come out the other side of this? And what options might be in play for you to deal with some of the issues that you're going to have? Probably not something that the banks are going to look at now, probably focuses elsewhere, and you know, there's capacity constraints, but this is certainly things that businesses can start looking at as we work through towards next year.
Okay, thanks, Neil. In other words, you may need to be thinking about debt restructuring now if you haven't already done so.
Exactly.
Yeah. Okay, thanks again. Anne Phillipson next on leadership and new ways of working. And they say every crisis creates an opportunity, and so how can really boards and senior teams come out stronger from this crisis in terms of their people?
Thank you. Good morning. Yeah, I do think that there is an opportunity amidst all the doom and gloom of coming out stronger. And when you think about any relationship, and if you've gone through a challenging time together, quite often when you come out the other side, you're stronger and more connected. And I think the same can be said for senior management teams and boards. You know, everyone has been pulling together to fight a common enemy, in this case, a pandemic. And actually, that can really strengthen the relationship. So I'm hearing stories from clients of SMTs working more closely together than they ever have before. And I would encourage SMTs and boards to take some time out and to reflect on what they've learned about each other during this period and how they can then continue with some of these new practices once the crisis has passed. So I've put up a few questions there to prompt that. And they say we don't learn so much from doing, but actually reflecting on doing. So taking some time and having some more reflective board meetings or senior management team meetings to ask the big questions. You know, how is this crisis fundamentally going to change our business? And what are we doing to grasp the positives? Maybe what have we started during the crisis that we didn't do before, but we absolutely should continue? And you know, what have we learned about each other, and being so closely connected during this time? Another thing for boards to think about is what is our current horizon? So I know a lot of the COVID committees and everything has been focused, but is now the time to maybe start to make a shift from the immediate and the crisis timeframe to maybe a little bit more shorter term or even into the longer term? So something to think about in terms of reflective, taking time and thinking about how are we as a board, as a senior management team, I think will really pay dividends. We can go to the next slide. Obviously, communication is always important, but never more so than during times when people are feeling very anxious and there's extremely changing and volatile conditions. So again, I would encourage SMTs to think about what has been our communication, and are we bringing people with us as we go through this period. And sometimes when I've worked in a communications role on a big project, there's a hesitancy with the senior leadership to wait, and they say, well, we can't tell them yet because we don't know everything. And I think that's the wrong approach. I think there's an opportunity to bring people with you and to share your thinking. So, you know, a simple way of structuring that is to say, here's what we know, and here's what we don't know, but here's what we're doing to find out. And then here's what we're thinking about. So when you bring people with you and sort of reveal your thinking, then it's not such a surprise to them when you do come with your conclusions and share that with them. So I think there's a real opportunity to focus and to spend much more time thinking about your communication strategy during this period. And I love this quote from Maya Angelou. People will forget what you did and what you said, but they'll never forget how you made them feel. So thinking about how are people feeling, how are our customers, how are our staff feeling, and what are we doing to influence that during this period. So a few practical points around the communication. In terms of virtual meetings, I know most boards have had their first virtual board meeting. We're seeing council meetings being held virtually, and certainly lots of Zoom meetings in everyone's diary these days. But it's important to remember, especially when you're making some important decisions for the business, that Zoom meetings do favor the extroverts. So you really do have to think about how do we engage a little bit differently with introverts. This is not going to be their preferred method potentially, and the chair of the meeting may have to call the introverts in advance of the meeting and get their reflections on the agenda items and have a one-to-one discussion with them, which would be much more within their comfort zone. You're missing a lot of the body language, the cues that you get from people. So you may be having a board meeting and you're noticing that someone seems to be considering or objecting to what's being said, but you're missing those for the most part when you're doing this virtually. So again, it's really important to build some silence into the meeting, to have some pauses, and to give individuals the opportunity to speak up, because introverts typically are not going to fight for airtime, and they're not going to cut across in order to make their point heard. So just thinking about that, especially as I say, when it's a really important meeting and you do want everyone's perspective. In terms of decision making, there's obviously lots and lots of decisions to make. And sometimes I think we can get caught in this activity where we're in a crisis and everything has to be quick and everything must be decided immediately. But there is power in reflection. And I think it's important for boards and SMTs to take a look at maybe their agenda and say, these are the things we absolutely do need to decide immediately and today. But these are some of the things that we can reflect on and take a bit of time and maybe do a bit more research before we make a final decision. So you probably do have COVID committees. Just be careful that they're not going on too long, because the danger there is that the focus is very narrow and very short term and very reactionary, as it needs to be. But we don't want that to continue on, because obviously in any business there's very important things that aren't urgent that might not make it onto the agenda during this period. So scenario planning can really help, and a way to give people a framework for the decision making. And a very simple three by three would be looking at the economic. Mine's not as sophisticated as Andrew's. There's no letters in here. But if you were to take 3 economic scenarios, that we're going to have a bounce, that there's a depression or recession, and 3 exit from strategy approaches. It's going to be okay, it's going to be phased, or we're in lockdown the rest of 2020. So something that is appropriate for your business, but really helps people then to give them a framework for the decision making. The final point then is around the stakeholders, and thinking about, as a board or as an SMT, you can't keep everyone happy all of the time. So trade-offs will have to be considered. But I think it's important that the board is aligned around which stakeholders are our priority and how are those decisions then impacting those priority stakeholders. So there's been lots of evidence in the press of businesses that have identified, it's absolutely, we're putting staff first, or our customers are first. I was on a webinar, one of the CBI webinars, and the CEO was talking about suppliers and how important their suppliers are to their strategy. So it was a supplier first priority. So a guiding question: what's the right thing for us to do here, and what's right for those stakeholders? So again, those are some ways to frame some of the decisions for the SMT and for the board. And then finally, for me, as the strategy changes, and of course, as the external environment has changed dramatically, business strategy will have to also change. And so we may see a shift in board membership over the next year and a half. So as companies try to get the right strategy with the right resources and the right governance, we may see that they need to bring in different expertise and maybe NDAs to support the business through the next medium term. I guess the risk committee has probably never been as important, and most of the businesses that we've spoken to haven't had something like a pandemic on their risk register. But it's important that the committee is looking at those events that are, although highly unlikely, have a huge impact if they do occur. And finally, there is a real opportunity to build back better, and we're seeing lots of that in the press. But organizations are saying it's not going back to the way it was before the crisis. So if we want to build back better, what does that look like for us in each organization? And thinking about some of those big global issues like climate change or sustainability, things that we thought we could never do this, what we've just done. So, the way that companies have responded to the crisis, we've probably accelerated the digital, the sustainability agenda more in the last 2 months than we have in the last 5 years. So, what does building back better look like for us? And I think that's an important discussion for the SMT. And it's important to note that most major improvements and step changes really did happen as a result of war or crisis. So there is that opportunity. So Patrick, I think there is an opportunity to not only enhance the relationship with SMTs and boards, but also to build back a better business after this, if boards and SMTs take the time to really reflect on those key learning points.
Okay, Anne, thank you very much. Yeah, and it is an interesting point on the fact that you're saying that COVID committees shouldn't continue in the same form for too long, and focus on the bounce back planning if they can. Okay, we're almost there, folks. Just a few more minutes. One of the questions was, will the slides be circulated? And yes, we're uploading the slides later on to the website, and you can get them there. And also there will be a recording of the webinar, so those will be circulated. Just one question for you, Jean, and I suppose it links to how businesses have responded to the COVID crisis in terms of maybe manufacturing new products they didn't manufacture before, or looking at automation. Have you seen anything recently where that has happened?
We've seen quite a bit of that, and it's actually demonstrates what Andrew was saying earlier. A client yesterday has informed us that they're planning on spending £2 million on robots next year to automate their facility and to probably reduce the staff costs and be able to cope with a similar pandemic in future. I think it's important, if you're planning those types of activities, to link in with your advisors, because if he was to speak to me after the fact, it would be a capital cost, and it would be a very different relief than if you could get it into the P&L and get R&D tax credits. So we're actually working with them in advance to see if we can change the contract with the supplier to allow it to be more like a subcontracted R&D project, to allow the guys to get an additional 130% tax relief. So yes, they are changing their activities, Patrick. We've had other people now producing face masks and the likes in bulk for the NHS and the HSE.
Okay, thanks, Eugene. Andrew, a really cheeky question. Do you think Brexit will happen at the end of December, or will it be derailed, given that the Northern Ireland aspect was published this morning?
It's a really cheeky question, and I suppose there's a determination at certain levels of government to see it happen by the end of the year. I don't think there'd be, I think there's a good rationale for maybe pushing it back. Businesses have a lot to contend with at the minute, and to try and contend with new trading protocols at the end of this year might just be a burden that they could be relieved from for months or 6 months or a year. Wouldn't be beyond the realms of possibility to do that, and sounds quite sensible. But as I say, there's quite a few who are keen to push on and get Brexit done, to dust down an old phrase.
Okay, thanks. That was suitably caged and a vague response, but
that's my stock and trade.
Yeah. Final question, Neil. Restructuring, and this has come up in some discussions I do have had with clients. Restructuring debt is not using cheap finance from the bank supported by the government to pay off your more expensive debt, is it?
No, that's not the purpose of the schemes. The purpose of the schemes is to bring in additional money to help businesses, not to replace more expensive money. So, and I know some of the banks will have within their own policies that you cannot use these loan schemes to refinance. So no, that's not what it's for. It's more for supporting businesses by bringing in additional money to help with some of the issues that they're going to face.
Okay. Thanks for that. Well, I think that's everything, folks, in terms of the questions. We appreciate your time this morning. Again, contact details are there. If anyone wants to email a question or a specific query, please feel free to do so. So listen, it's left from myself and the panelists just to thank you for attending our webinar this morning. Hopefully you found the content practical, useful. And as we said earlier, we'll upload the content and slides later today onto the website. And if you still can't get them, just email us and we'll send them to you. So thanks very much and have a good day.